changes made last month, it's instructive to have a look at some of the developments that are driving markets at the moment. The rise of inflation, among other technical factors, was one of the reasons that led to the recent market correction. While stock prices have recovered since the February lows, it seems investors remain wary about where rates and inflation are heading. We still expect both rates and inflation to be on the increase, but also believe the pace of advances to slow to a less dramatic rate. There should be some stabilisation in terms of how much bond yields could increase from year on in. Our base case is for the US 10-year Treasury yield to increase gradually to about 3.25% in 12 months' time. Current market sentiment seems to indicate that the risk is to the upside of this level. While market volatility is expected to remain elevated for the rest of this year, from now onwards, a more modest pace of inflation increase should allow equities to absorb the impact and continue to make solid enough gains. In addition, historical precedence reveals that broad equity markets generally rose over the last 3 periods when the Fed hiked rates towards more neutral levels. The return of inflation to normal levels is typically a healthy consequence of rising growth and robust demand-side activity, as the economy nears full employment and full capacity. To a very significant extent, this has been borne out by the robust results posted by US stocks in the fourth quarter. While there is some possible distortion due to the tax handout of Mr. President, the underlying trend is strong and looks to be sustainable as long as growth remains robust. At the moment, the pace of inflation rises is not sufficient to force the Fed into action that will abort the cycle. We stay engaged in the market.